This chart tracks the US dollar's falling purchasing power since 2000 against the rising consumer price index. The expanding shaded gap between them represents the exact value lost by holding uninvested cash. Currency structurally devalues, acting as a continuous tax. To avoid this penalty, large financial institutions and high net worth individuals systematically transfer their depreciating currency into hard assets. By parking capital in properties, equities, or commodities, they force their wealth to ride the wave of rising prices instead of being drowned by it. It reverses the inflation penalty, turning a macroeconomic problem into a growth engine. But there is a catch. The 5 standard inflation hedges, real estate, debt, gold, crypto, and stocks, are constantly pitched online as universally applicable strategies. They absolutely are not. Taking on a massive mortgage to buy an investment property works if you have deep cash reserves to cover vacancies. If you are an everyday earner without that safety net, borrowing hundreds of thousands of dollars during volatile economic times is incredibly dangerous. To protect your savings without risking financial ruin, you have to ignore broad advice about what the wealthy do. Instead, you need to audit these 5 specific asset classes against your actual capital, your cash flow, and your personal risk tolerance. The first and most established inflation hedge is real estate. It provides a massive physical anchor because land and structures possess intrinsic value that outlasts currency fluctuations. But accessing this asset requires strict inputs. You need substantial upfront capital for a down payment, thousands in reserve for closing costs, and a premium credit profile to even get to the closing table. If you meet those requirements, the outcome is powerful. You secure an appreciating property and permanently lock in your housing costs, completely insulating yourself from market-driven rent hikes. Let's look at the data matrix for our options. For real estate, the trade-offs are clear. It demands a high barrier to entry, it is extremely illiquid, it ties you to a specific geography, and it requires ongoing cash to maintain the physical structure. This leads directly to the second, closely related strategy, fixed-rate debt. Most people view debt negatively, but fixed-rate leverage behaves differently during inflation. You are borrowing currency at a set interest rate that is often lower than the rate at which the currency is losing value in the real world. Over a 20 or 30-year timeline, you repay the bank using future dollars that are mathematically worth less than the ones you originally borrowed, all while you keep 100% of the property's appreciation. Looking back at our matrix, adding debt introduces a high volatility risk. Leverage multiplies your gains, but if the property value drops or you lose your primary income source, the debt payments remain fixed. You need ironclad cash flow to avoid default. Real estate and fixed-rate debt create a tremendous wealth multiplier. However, deploying them without significant upfront capital and highly reliable income turns an inflation hedge into an active liability. Our third option is the historical doomsday anchor, gold. Gold functions primarily as a psychological safe haven. When the market panics or currency systems face extreme stress, investors reliably flood into precious metals, driving the price up exactly when everything else falls. Checking our matrix again, the main trade-off becomes obvious. Gold produces no active yield, it pays no dividends, and generates no rent. It simply sits in a vault, and historically, it loses value as soon as economic stability returns. This brings us to the fourth asset class, cryptocurrency, which operates as a modern, digital attempt at speculative asymmetry. The appeal here is based on fixed supply limits. Similar to digital gold, the strict scarcity programmed into the code creates the potential for massive, outsized returns when market spikes. Here on the matrix, you can see the cost of that potential. Crypto carries extreme volatility risk. It is subject to sudden regulatory crackdowns, severe short-term drawdowns, and unpredictable hype cycles. Both gold and crypto are highly accessible to retail investors, yet they remain entirely passive. One is a historical insurance policy, the other is a high-risk speculation. Neither generates the recurring cash flow necessary to consistently outpace rising living costs. That leaves us with the fifth asset class, stocks and public equities, the active compounder. Buying a stock means you are purchasing fractional ownership in a living, operating business. These businesses actively fight inflation for you. When raw materials and transportation costs rise, successful companies simply raise the prices of the goods and services on the shelf, passing the cost of inflation directly to the consumer. Those increased consumer prices translate into increased corporate profits, which are then passed back to you, the shareholder, through steady dividends and long-term stock appreciation. The final row of our matrix shows why this is appealing. The barrier to entry is virtually zero. The trade-off is that you are exposed to broad market corrections, demanding strict emotional discipline to hold your positions during a downturn. Ultimately, equities act as the most balanced hedge for the everyday earner. Because businesses organically absorb rising costs, your capital participates in the growth of the entire economy rather than being slowly eroded by it. To survive a high inflation environment, the rule is simple: you have to convert cash into assets. But the right asset depends entirely on your current financial foundation. This decisional flowchart maps it out. The primary question at the top is, do you have high upfront capital and highly secure cash flow? If the answer is yes, you fit the optimizer profile. You are in a position to safely leverage bank money to acquire real estate and lock in a tangible appreciating asset. If you have lower upfront capital but consistent monthly income, you are the everyday builder. The chart moves you down the stable path to diversified stocks. This is the definitive low-effort choice for long-term compounding. Finally, if you are seeking either high-risk asymmetry or crisis insurance, you become the speculator or defender. Here, crypto and gold should serve strictly as minority allocations in your portfolio. Adopting an aggressive strategy, like heavily leveraged debt or highly volatile crypto, without the required capital buffer, will inevitably amplify your losses the moment the economy squeezes. During a period of rising prices, the single worst decision is to leave your savings in cash and do nothing. Identify your profile, choose the financial vehicle that matches your risk tolerance, and put your dollars to work.